Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the week that was, the weekly podcast that wraps up market movements and events from the past week along with their implications on asset markets. I'm Michelle Castellino, your host for this week's episode. Markets ended the week lower, with Nifty down 0.8% and the Sensex falling about 0.7%. Broader markets also saw declines as mid-caps were down sharply by 1.57%, while small caps were relatively resilient, declining just 0.16%. The decline was driven by a sharp IT sector sell-off midweek, persistent FII outflows, raising fears of Fed rate hikes, and a cautious RBI tone in the latest monetary policy meeting. A key setback came in midweek when the IT sector dropped nearly 5%, reversing the prior day's surge. Given its significant weight in the benchmark indices, this alone dragged the market down by more than 1% in a single session. Global cues reinforced the weakness. US job openings hit their highest level in nearly 2 years, fueling expectations of Fed tightening. That pulled capital away from emerging markets like India. On the sectoral front, telecom saw the highest gains of 1.92%, continuing its strong momentum amid robust Q4 results and accelerating 5G infrastructure expansion in India. Utilities saw the steepest fall of 2.48%, followed by FMCG, which was down about 2%, amid demand concerns and margin pressures from elevated input costs. RBI's decision in the 5th June policy meeting was largely in line with expectations, with rates held steady at 5.25% and a unanimous decision to stay on pause. However, the tone was clearly more guarded rather than accommodative. The key signal came from the sharp upward revision in inflation projections to around 5.1% for FY27, while growth forecast was trimmed to about 6.6%, indicating the rising macro risks and keeping the possibility of future rate hikes on the table. So while the stance remains neutral, this was not a dovish policy. Instead of hiking rates immediately, the RBI has used its inflation guidance to keep markets cautious, signaling that easing cycle is behind us while still avoiding any premature tightening that could impact growth. At the same time, the central bank has rolled out a broad and coordinated INR supportive package, working alongside the government to attract capital flows. Measures such as FCNR deposit support with full hedging, concessional swap facilities for overseas borrowing, easing of FPI norms, tax incentives on government bonds, and restoration of export repatriation timelines also point to a clear strategy, bringing in USD liquidity to stabilize the currency. The RBI is effectively using multiple levers simultaneously, from encouraging foreign borrowings and deposits to improving bond market attractiveness. This is to manage external pressures and prevent disorderly moves in the rupee. The relatively short window for some of these measures also suggests an intent to accelerate near-term inflows. Over the past week, the rupee strengthened marginally against the dollar to close at 94.9, while the 10-year GSEC yield dipped slightly post the policy meeting to close at 6.98%. Oil prices rose about 1% over the week, keeping inflation fears alive as US-Iran talks stalled and regional tensions prevented any supply-side relief. On the macro side, new IIP data with 22-23 as the base year came in last week. April IIP improved to 4.9% year-on-year, up from 3.2% in March, driven by strong manufacturing growth of 6.2%. As per use-based classification, growth was led by capital goods, which grew 16% year-on-year, intermediate goods, which grew 7.7% year-on-year, and infrastructure and construction, which grew about 7.1%. The new IIP series has improved its sectoral coverage, now including gas, water supply, sewerage and waste management, which improves the comprehensiveness of industrial activity measurement. It also considers a significantly broader dataset of 463 items versus the 407 earlier, which reflects a more representative and current industrial structure. That's all for this week's edition of The Week That Was. If you found this update useful, don't forget to like, share and subscribe. Thanks for tuning in and have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.